Hey everyone. So I last walked through how to read an options chain, and I used Amazon as an example, and mainly broadly looked at like how I'd pick an expiry date, a strike price, how to read the options chain. So I was going to go into a little more actually with each video I make. I'm going to go into just a bit more detail and a bit more detail because I guess I won't say that there's necessarily a procedure like I'm following steps 1 through 10 so much as there's a whole multitude of factors that I'm keeping in mind, and then I'm making judgment calls whenever I'm entering and exiting a position. I'll dive into a little bit more on how I screen what I'm going to pick and then my entry point, right? So first thing I'll do is um, I'll look at what tickers am I going to consider. So I'll look at the charts for this, right? So what I'm typically doing is I'm looking for red flags. A lot of my whole strategy is all around I want to minimize the losers. So I mentioned how I only sell put options on stocks that are in already my buy and hold portfolio. So let's look at a few. Palantir is one that's been in the news. If we look at this 1 month chart, this graph here, it's a lot of red and it's a lot of decline. By the way, these are at the time I took these snapshots, and so it might have changed already since then. Um, Looking at this graph, price has gone down. It doesn't even look like there's a curve up. Then the next question I would ask is, I mean, if it's gone down for several days in a row, are we expecting that it will just keep going down farther, or is it a stock that overall trends generally in a healthy direction, generally up? So that's a 1 month chart, but then I might expand to look at a 3 month chart just to get a broader time horizon. So I see, okay, generally trending up. Just to sort of get even a broader picture, I might look at a 6 month time horizon. And we see, yeah, like the stock price has generally gone up. We see it go down a bit. Maybe um, I would say Palantir in this situation, I might be on the fence whether or not I think it has more to go because it has gone up quite a bit. So I would say I wouldn't rule out Palantir. I'll look at a couple other examples of stocks that I have in my portfolio. So very different industries. We got JP Morgan, we've got Caterpillar. They generally trend up and at a moderate pace. And you can see Caterpillar dips a little bit recently, which is, in my view, actually okay because now there's, in my view, is maybe less of a chance of a dip. Do I see a red flag in what I'm in these charts that make me just rule them out for selling a put option? And so far, with Palantir, JP Morgan, and Caterpillar, no. Now, there's another stock that I added to my portfolio a few months ago, AST Space Mobile. I'll probably do another video where I actually talk about the stocks I hold at another point in time. But for the purpose of this conversation, let's just look at the chart. It's gone up in a really short time span. From June to July, it climbed like 100%. And since its peak there in mid-July, it's been declining. I'll call a red flag on this chart. It doesn't just trend up over a span of like nearly a year, right? It's mainly sideways, but shoots up. I don't know, is it going to keep going up at a healthy, moderate pace, or is it gone up and now it's just going to go down? I'm bullish about the company in the very long term, which is why I have it in my buy and hold portfolio. But for the purpose of selling a put option with an expiry 30 days out, I don't know where it could go. It could go all the way back to 25, right? So I'm going to put a red flag on ASTS and not sell a put option on ASTS. I'll open another chart of a stock that I hold in my portfolio, and I'm going to pick Nvidia. And I'll look at the 3 month chart. Question is, can I sell a put option with a 30-day expiry? I look at this chart. We see some red a little bit, but we also see some green. I see a red flag. So now it's a candidate for me to sell a put option. Now, that's where, okay, let's look at the options chain. So for Nvidia, the strike at the time the current price at the time I took the screenshot was $170. You see that in black in the middle. I'm picking the expiry date 30 days out, September 19. Previously, I just really talked about strikes versus current prices. I'm going to get a little more granular now. That's where our risk measures come into play. You can see the charts there, delta, gamma, theta, vega. To be honest, I don't use gamma, theta, vega. If I get questions about them, I can answer them, but I really don't use them. Theta is implicit. I'll quickly cover that right now. Theta is really referring to time decay. For every day that goes by, that theta, that number there, represents the decline in the price of the option. So if you look at $162, like the strike price, by the end of the day, it would go down 14 cents. If all the risks were the same, if everything else held the same, like the current price, etc., then the price of that option would go from the bids and asks would probably decline. Instead of 540 or 550, it'll go down to 526 and 536, right? That's what theta represents. I don't need to look at it because we know that I covered it in the last video, that premise of my trading, right? The fact that I sell a put option, say 30 days out, and then over the next few weeks, it's going to decline in price. So theta goes in one direction. I don't need to look at theta. If the price of the underlying, or if there's other factors in the market or that affect the stock, affect the options price, like theta will change, yes. I mean, but at that point, I'm not even looking at theta. I'm looking at all the other things, and we'll get into that both in this video and other videos. What I do look at is delta. That number will represent how much the options price will change given a change in for a single dollar in the price of the underlying stock. So at $162 strike, right? So that option there that you're selling, that Nvidia put option expiring September 19 at strike 162. If you bought that if you held that option price, let's say it was bought at $5.45, right in the middle of the bid and ask, that would decrease by, say, 33 cents. So that's how to read delta. Some people will use that as an approximation for like the probability that the option would actually get exercised, that I would be forced to buy the 100 shares. That really only holds when you're actually quite close to the current price. For example, the strike price of $168. Yeah, there's a 42% chance, you can say delta, the 42% chance that that you could end up getting exercise 168. Generally speaking, across all my stocks, I sort of will sell put options around 20% below. I generally think, how often is a single stock price dropping 20% in a 30-day period? And usually if it were to drop that much, it would be in a day or two. And adding on, like, drop that low without it actually still climbing back up within 30 days. I think it's relatively safe, and if you look at a lot of the options pricing, the delta, the returns you get are quite small at that probability, which also indicate generally quite low risk of an option being exercised at strike prices about 20% below. And then for some stocks that are even slower moving, like Coca-Cola or P&G, I mean, it might be even lower, like 10%, right? You might not even see 10% moves. So I generally look farther away. There might come a time when I take a little more risk, but my view is I just don't even want to have the chance of assignment. So I typically look at options where delta is between 0.05 and 0.1 depending on the stock. So usually once I get past 0.1, I think I'm generally okay to sell a put option. That's because I have enough of cash buffer to take on assignments. That's because I have enough leverage that I'm not dependent only on these trades to make money. I'll make multiple trades across different options, different stocks. So if I look at the Nvidia options chain, I showed you the first half, but it goes much higher up, right? So I might look at strike price $141. That represents about a 17% drop from 140. A strike price of 141 represents about a 17% drop from $170. So looking at that chart, do I think it'll drop all the way to 141? Yeah, I think it's less likely to drop that far and not go up within 30 days. So I'm going to zero in on that. We see bid $135, ask $137, delta 0.095. So I'll put in an ask at, say, 136. I'll likely get filled, and in worst case, I'll sell it at 135. I'll take that $135 cash, and then I'll wait, and I'll keep that cash. Then as soon as the option price turns profitable, say 10%, 20%, like $13, $26, then I'll just buy that option back, and I'll keep the cash. I'll keep the $26 and then look for another trade to make. So I dove into a bit more detail there. Again, more nuances, more things I consider. I'll elaborate as time goes on. I don't want to just cram it all into one video because I think then the details get lost. I'll go into a bit more detail in another video when we talk about how that becomes a factor with trading, and it's not just simply I sell the option and then I just wait till expiry, or I just wait till time elapses, right? I'll talk about the effect of the underlying in my trading another time. So I hope that gives a bit of insight into how I rule out what I'm not going to trade, and then once I know what I am going to trade, how I pick what my entry point is. What I look for is basically I'm considering delta, like less than point one, and is the strike price associated with that delta sufficiently, like, far enough below the current price that I feel comfortable even taking on that risk. So I hope that helps, and I'll come back with more later. See ya.